So the balance sheet, we've talked about an introduction to the basic layout, how we value those assets, the deferred tax issues that arise because of it. And there's a few more issues that we want to go over before we actually build our balance sheet. One of these relates to raised breeding livestock. On a cost-based balance sheet, assets are valued at their cost less accumulated depreciation. When we raise those livestock, all of the expenses that went into it, the feed, the vet bills, all of those things, were actually just deducted on the income statement as our general feed, veterinary, and other bills. And so there is no cost basis. So if we had a balance sheet on a cost basis with zero value for these raised breeding livestock, that could really distort the balance sheet. And so we need some way of getting around that. And the way that we get around it is that raised breeding livestock are valued at a base value per head. And so we just pick a conservative value that we can use over many different years and times however many head we have at that base value. That base value it would be like $500. And if you had 100 head, 100 times 500 would be $50,000. The value of raised breeding livestock on a cost-based or book value balance sheet is the number of heads times that base value. Mortgages are another issue. Mortgages and long-term loans are going to be paid off over multiple years. The payments are principal, which reduces the amount owed, and they also include interest that you've incurred since the last time you made a payment. Current liabilities are everything that's due within the next year. Non-current liabilities are everything that's due after the next year. So where do we put mortgages in the interest owed since the last payment? Think about that. We're going to pay those mortgages off over multiple years, but we do have some that's due within the next year, and that interest we owe right now. So we split the remaining principal that we owe into two parts. The part that's going to be paid in the next year and the part that's due beyond that time. The part paid in the next year is a current portion for term debt. It's a current liability. And the part that we're going to pay after the next year is the mortgage or a non-current liability. Sometimes it can be called a note, a mortgage, loan, whatever you want to do. And it's going to be the principal that's due that you're going to pay off beyond after the next year. Accrued interest is a current liability, and it's the interest that you've accrued, you owe, since you made the last payment and when you prepare the balance sheet the end of the year. Since it will be paid during the next payment, it's a current liability. So we're going to pay it within the next 12 months, so it's current. Let's do an example here. Suppose you took out a loan October 31st, 2010. The loan amount was for $100,000, 8% interest, and it's a 20-year loan, so you're going to pay it off over 20 years. And assume you just have annual payments. So for 2010, our current liabilities include accrued interest and current portion term debt. The accrued interest is basically 2 months of interest because we took out the loan the end of October, so we'd have November and December on $100,000 at 8%. So if you took $100,000 times 8% and divide it by 12, that would be the interest for 1 month. Times it by 2, you've got the interest for 2 months. So accrued interest here is $1,333. In practice, a lot of times, actually the lending institution or the bank where you borrow the money from, they will split your payments out and actually give you the information on what you're going to owe within the next year. The current portion term debt is what you owe on the principal, part of that $100,000 that you're going to be paying off over the next 12 months. And then the non-current liability for the mortgage is the part that we would be paying off beyond the next 12 months. So since we just took out this loan in October, at the end of the year at the balance sheet, this $21,885 plus the $97,815, these two should add up to the total of $100,000 which we owe, because we owe the whole $100,000 plus the interest that we've incurred. The next year, we take this $97,815 that's still owed on the loan in future years, and we've got to split it up into the part that we're going to pay during that year and the part that we're going to pay in later years. And so if we add these two up, this should equal that $97,815. The other thing to look at is your principal actually goes up over time. and your interest payments go down over time. As we get to the third part of the class, we'll show you exactly how to make these calculations when we talk about the time value of money. But it's just something to note here. The interest is going down because we owe less money, and we pay interest on the money that we still owe. And so here we owed $100,000, and so we owed $1,333. But here we only owed $97,815 since the last payment, so there's less interest. And here we owed $95,455, so less interest. And so you can kind of see how that happens and how they would correspond between different years. So some other things to consider is a prepaid expense and supplies. A prepaid expense is some expense for like a subscription to a magazine or another service, sometimes insurance that we've paid ahead. So you might have paid for a whole month worth of, or a whole 2 years worth of insurance or something, and so that's a prepaid expense. A supply is something that we've bought and is on hand, but we haven't used it yet. And so fertilizer that we've bought and we're storing, or seed that we've purchased and we're storing, is a supply. It's on hand, but we have not used it yet. You might do something like plant your fall wheat, and so in that case, we've used the seed and we've planted it and it's out in the fields. And we want to value it because it has value that we have that grown, but it's not really wheat that we have in our bin that we can say we can sell. So the way we value that is cash investment in growing crops, and it's it's a current asset, and it's usually listed at the bottom of the current assets, and it's just a value of the cost that you have into it. So that's one place where we're valuing the current asset at the cost that we have into it rather than a market value. Tools. Technically, tools and some of those things that you'd buy, like a screwdriver and a hammer, you may actually keep them around for more than 1 year, and we use them to produce other things, which is kind of the definition of a non-current asset. But you're really not going to value and keep track of all those little tools as non-current assets and depreciate them out over time. And so one concept that we have is called materiality in accounting. Materiality says for these really small things that don't make a material difference, we actually just consider those expenses and we write them off. So we're going to put this into practice and build your Excel worksheet. You're going to do this over the next 5 modules, and the first one we're going to do this week is to build the balance sheets. And so some things to think about in your Excel worksheets. We really want to only put a number in, type it in once within the worksheet, and then use reformulas to refer to them elsewhere. This is because if we need to change it, we made a mistake, we want to redo it, we want to be able to change that one place within the whole workbook and have it change everywhere else automatically. We color code that so we know where we put in numbers and where there's formulas. I've started to use a yellow background for the cells that I put numbers in and no background elsewhere. Then I know when I come back to it a whole year later or 2 years later or months later, I know that the yellow background are the cells that I have to change the numbers for, and it's going to calculate everything else for me. Sometimes you want to make your notes, and so in Excel you can have your print area, which is when you print them off, that's what people are going to see, and then you have some areas to the side and to the bottom. I make notes out there to the side so that you can have those for future use, but when you print them off, it's not going to print. Some things, when I come back to, they're not really yellow cells that I type numbers in and it takes care of it, and they're not really formulas. Sometimes they're things that I need to check, or I need to do some manual calculations, or I need to make sure they're filled in correctly. And so I've used a blue background here for places where I need to check things every time I use that spreadsheet. And so the next module will actually, the next video is going to show you how to do this.